Hey everybody, welcome back to another episode of the CFO Podcast. As you know, in this podcast, we try to explore the journeys of financial thought leaders who are shaping the future of businesses. For this particular episode, I couldn't have been more excited than I am because my guest CFO is a tech CFO. He has led the financial strategies across various startups in different sectors, from fintech to property tech and previously talent tech. And he has seen it across the life cycle of startup from early stage, fundraising, growth stage, and beyond. So there's a lot to learn from my guest today. He is currently serving as the CFO of Holo. Holo is a pioneering property tech company which is redefining how we do mortgages and home financing in today's world in the UAE. Without waiting further, I'm going to introduce you to my guest. His name is James Evans. James, welcome to the podcast.
Yeah, thanks for having me. Pleasure to be here.
Thank you very much. So James, there's a lot that we're going to extract out of your experiences or your career, and I'm sure there's going to be immense value for the audiences around how startups work, how do you define the strategies at different stages of the life cycle of a startup, and how to approach fundraising, how to deal with the stakeholders around investors and CEOs and the board. So there is a lot that I can already foresee you're gonna give into this podcast. So just like we do every time, I'm going to start with sort of basic questions around your early life. Where did you grow up? What were some of the influences around you or your life that shaped you how you are today?
Yeah, so I actually grew up in Dubai. I moved here with family in 2000, so when I was 10 years old. So I've been out here, coming up 25 years this summer. I think growing up in Dubai is really what shaped me. I think Dubai as a place it's a place that rewards ambition. It really rewards drive. So I think growing up in that kind of environment, you're always pushed to do a little bit more, maybe strive for a little bit more as well. And I think it's quite different from the UK in that regard. I think in Dubai, success is so celebrated and successful people are so celebrated in Dubai, which is incredible. And it pushes you to do more. And then you're surrounded by people who are very successful and your peer group is doing incredibly in their career. And that just makes you want to do more and more. So I think from a fairly young age, I had bigger goals for what I wanted to do. I always wanted to be a CFO. That was the number one goal. Once I got there, I didn't really know what to do at that point. That was a bit like, well, what now? I've had like this big goal for 11 years and now I've done it. So I felt a bit lost at that point, but I think I've refound it now with startups and trying to grow out the MENA ecosystem, because I think growing up here as well just made me really quite passionate about the region. I think we don't always get seen in the best light internationally. So it's just a cool ecosystem to be in. It's so young here as well. Startups are so young. So it's really fun to feel like you're a part of that almost like founding team of the region in a way. I think that's super fun.
No, yes, absolutely. The only thing that I can add to this is how I've seen Dubai. I've been in Dubai for now 8 years. Of course, you've been here much, much longer. But Dubai has its own Dubai culture where people coming from various cultures blend into that one culture, which is the Dubai culture. And that speaks to what you just said about celebrating success. James, were there any particular sports, hobbies, etc., that you followed in your early days, which of course had an influence in shaping you up?
I played basketball growing up. I played football a bit as well. I'm not very good at football. I'm better at basketball. But I've always played competitive sports my whole life.
Yeah.
I think it's something that is great for kids to get into. I think it trains you for life, teaches you how to be part of a team, teaches you that competitive edge as well, which I think you desperately need as you grow in your career as well.
Yeah.
As much as we don't want to say it, careers are competitive. So I think playing sports from a young age has always been good part of my life. Some of them I'm glad I did. I'll be honest, I'm getting older, so I watch more than I play these days. But I still try and play a little bit of basketball here and there.
Yeah, yeah. So James, from a first job perspective, I of course saw that you started your career with PwC in the audit division, and of course moved your way up into TAS, which is transaction advisory services. So there's a lot of looking into financials, preparing the financial models, a lot of data to handle. How do you think those early interactions with data and financials sort of shaped some of those foundational things in you, which you still use up to date?
Yeah, I think I would include audit in that as well, because I think what you get at PwC is you get exposure to a lot of different companies and a lot of different business models at a very rapid rate, right? Even if you're in audit, you might be doing a consumer goods company for 3 weeks, and then the following 3 weeks you're on an industrial producer, or you're on a retail shop, or you're in a financing company. So I think that exposure to what a lot of different businesses look like, from both an audit and a transaction point of view, is is a really great foundation for a career in finance, because it allows you that ability to, if you go into new companies, and particularly in startups where you need to get up to speed very quickly, you have that background of being able to very rapidly learn about a business and be able to know what the numbers in that business mean. So I think without that start in PwC, it'd be a lot more challenging to onboard to new startups, and I would probably take a lot more time to get up to speed with their business model and what their numbers mean. But that background has allowed you to sort of process information very quickly, understand business models very quickly. So for sure, I think, and I say this to everyone, working at PwC, you yourself know, it's not easy. It's not an easy job. Like, the working hours are long, the environment is tough, the environment's very competitive. But I think anyone who is about to enter a finance career, join a Big Four. After university, go to Big Four. You're going to have a horrible 4 or 5 years. It's going to be really, really tough. But when you come out the other side of that, you're going to be so much more ready for a career. And 5 years in a Big Four, it sounds a bit braggy, but it's almost like 8 to 10 years in a company, just because of what you get exposed to, and then the speed of learning that you have to have at a Big Four. And again, it goes back to that Dubai point, really, where in Big Four, everyone is really ambitious. So you get so driven by your peer group, whether it's like the graduate scheme you joined with, but everyone is striving to be the best in their group when you join a Big Four. So that drive, it just makes you want to learn more. It makes you want to push yourself a bit harder. So I definitely think do the 3 to 5 years. Like, everyone knows there's certain exit points from a Big Four, but if you don't want to go all the way to partner, do the 3 to 5 years. You're going to be so far ahead in your career than someone who did 5 years in a company, or whatever that may look like. So yeah, it's going to suck, but do the time and start there.
That is so relatable, because early in the day, when you're graduating out of your university or institute as a chartered accountant, whatever it may be, there's always these two options. Either you start directly in an industry as a assistant finance manager, or you start off with an audit associate. One, of course, glitters more than the other, which is to go in an industry directly, because you might be working with a big company. But the fact that the learning curve is so steep in a Big Four,
Yeah.
the sheer amount of data that you're loaded with, the sheer amount of competing deadlines and sort of competing priorities, of course, then they make you quite strong to take up bigger things later in the career. So definitely agree with that. James, moving into your professional experience beyond PwC, again, as we know, you're currently working as a CFO of Holo. Tell us something about Holo. What does it do? What problem is it solving? And because it's solving that problem in the UAE as of now, how do you see the UAE property market? What are some of the dynamics of the UAE property market?
Yeah, so at Hulu, at our core, we're trying to make home buying easier and more accessible. I think if you look historically, if you went out to get a mortgage and you go through the process of speaking to all the different banks, most people will go to their own bank first. You'll see the banks that your own bank can offer you. Does that mean that's the best product in the market? Maybe, maybe not. But if you want to get that exposure to all of the banks, you have to go around and you go to 5 or 6 different branches and you talk to 5 or 6 different relationship managers just to get that information. And what you have is, when you're going directly to the banks, the relationship manager is selling to you at the end of the day. They want you to take the product. They're going to have that hard sell on you.
Yeah.
So at Holo, we thought, one, how do you digitize that process? How do you take people out of having to go to the banks and having to submit all of their paperwork in person at banks? And also, how do you get people access to all of the banking products? So Holo was built by 2 founders, Michael and Aaron, who are both lifetime mortgage brokers. They did it offline for a very, very long time, and then thought, okay, let's digitize this process. Let's give people access to all of the products in the market, and let's not be selling any of these products, right? Like, let's make sure that the consumers are getting suggested the best mortgage product for them, whether that's the lowest rate, the lowest upfront payment, the quickest to complete, whatever that may be. Make sure that people are getting the correct product for them. A mortgage is the single largest piece of debt anyone's ever going to take in their life. If you get locked into the wrong product, you do see things like what happened in 2008, where we had the subprime crisis and things like that, where people took the wrong products and people were over leveraged. So we're really trying to simplify that process for people. Also make it a more enjoyable experience. At the end of the day, buying a home should be a really enjoyable process, but because of all the admin around it,
Yeah.
it isn't. So once we had that in place, the next step was how do you make the actual property purchase step a little bit better? So what we've recently launched is a product called the Hub. What that does is it lists you as a buyer, say Assad, budget 3 million dirhams, looking for a 2-bed in Marina. That gets posted onto the Hub, and then all of the real estate agents in Dubai have access to that platform. So if they have stock, if they have something that matches with your criteria, they can send that directly to you. Our team vets those properties for you, finds 3 or 4 that are a really, really good match for you, and saves you the trouble of, scrolling through Property Finder, trying to find the property, or going to see 20 properties where maybe 2 of them were right for you. So we're just continually iterating on that. Is how do we make that home buying process better? I think in the context of property in Dubai, I mean, we've been in an almost perpetual boom since COVID.
Yeah.
We see transaction volume going up month over month. We see property prices going up month over month. And it's a combination of things. You have a lot of people moving to the UAE. So there is that huge demand for new property. And on top of that, we have a lot of supply here in the market. There's a lot of really great off-plan developers here, and there's a lot of great developers in general here that are putting new new communities on the market all the time. I think it's something like a new property hits the market every 16 hours at the moment. Do I think it lasts forever? Probably not. Eventually, you're going to find a balance. I don't think there's going to be some big crash in the market. I think maybe a small correction or a flattening of prices is much more likely to be seen, because as long as the demand is there, you're never going to see a proper crash. And I don't see the demand for people living in Dubai and the greater UAE slowing down anytime soon. So I think it's a very good market at the moment if you're in the property game. For us, the great part is no matter the market, people buy houses. So mortgage is less reliant. It just means if property prices go up, our ticket sizes go up a little bit, but the volume stays roughly the same throughout, because people buy homes when they're ready to buy a home, not when the price is right. If you have the down payment, you've just had a baby, maybe it's time to buy a home.
Yeah.
You're going to buy a home no matter the interest rate, no matter the property price. You're going to buy a home at that point because it's in your plan. So I think there's some skepticism around the Dubai property market about can it last forever? It's not going to boom forever, but I don't think we're going to get a crash here anytime soon.
Thank you very much. Those are useful insights, definitely. Just trying to understand and unpack the Holo model a little bit more. So definitely, there is this platform where people know that they can find and compare mortgages. They don't have to visit the individual banks themselves. So that's definitely one problem that you're solving. At the back end, do you generate mortgages on your balance sheet, or you have banks who you then basically you originate the mortgage for them, and then basically they would have the mortgage on their balance sheet? How does it work?
So it's bank balance sheet. What we do is the document collection process. We do a little bit of KYC for the banks as well.
Yeah.
And then we package those cases and send them digitally to the bank. So what we're doing is rather than going through a relationship manager, our cases are going straight to bank credit teams when they can then approve or disapprove the loan. At the end of the day, they still have to do a little bit of work. It's their balance sheet. They're going to have to do their KYC as well. But what we're ensuring is that as a customer, you're not having to go through that back and forth process with the banks. It might be that you send 5 documents, the bank comes back, asks for another one. We manage that for you, and then we manage the case through the bank for you as well. So our relationship exists on 2 sides. We have a relationship with the banks, we have a relationship with the customer. It's very much like a middleman brokerage type agreement, just digital.
Wonderful. That is super useful. I'll just talk about a little bit on the macroeconomics. So again, mortgage is to do with interest rates. I know you said, and you rightly said, that people buy not just when the rates are down, but they have to buy when it's in their plans, correct? In the UAE, as we know, the interest rates are, of course, driven from the interest rates going in the US Fed, of course. The good thing for home buyers is that the interest rates are slightly going to come down as expected. How far do you see people in the UAE are interest rate sensitive? Does that drive their propensity to buy? Or what we hear in the papers is that quite a lot of property buying in the UAE is on cash, and people are really insensitive to the interest rate movements because, it's not in the equation. How do you see this? Is there a balance between the two?
Yeah, so if you look at all property transactions in Dubai, around 70% are cash transactions.
Whoa.
So you're only talking about 30% of the property market being mortgage. which is why you don't see a huge amount of interest rate sensitivity with the market. Where you see interest rate sensitivity is at the investor level. It's not at the home buyer, home owner level. It's more at the people who are buying their fourth or fifth or sixth investment property. Now, those people, because they're looking for specific ROIs on their investment or whatever it may be, they'll have a target return on it. So for them, the interest rate matters. But for a home owner, if you're planning to buy a house and live in it, the interest rate is less important, right? This is a 25-year loan. I think most people are understanding that the interest rate is going to go up and down over time. And if you look at your average interest over that 25 years, it's not going to change massively no matter when you take it. So there isn't a huge amount of interest rate sensitivity in the mortgage market. And due to the mortgage being 30% of the total market, even if it was, you wouldn't see a massive impact. I don't know why Dubai is such a cash-heavy market. It's a bit of an outlier property market in that regard. I think it partially because you do see so much investor-level buying here is a part of it. But also, I mean, the other thing you have is mortgage is not a super old product here. You're not talking about a UK market where the mortgage is a very, very mature industry and it's been around for a long time. There's still a number of people in the UAE who would qualify for mortgages in the UK that don't qualify here. So if you look at your business owners, it's very difficult to get a mortgage here. If you're someone who's a high net worth individual, but you don't have a consistent income, it's very difficult to get a mortgage. And what we've seen is a lot of those cash transactions are people who would have taken a mortgage if the banks were able to mortgage them. But the bank mortgage process here is still very black and white in who qualifies for a mortgage. So if I said to you, Sad, there's someone out there who has $100 million in the bank, but they haven't earned any income in the past 6 months, the banks won't provide them with a mortgage, even though this is a very secure loan. And you're talking about someone who's not going to default and the default risk is so low, but they would still struggle to get a mortgage. And most people at that level understand time value of money and things like that. So they would take a mortgage if they were able to get one. Whereas if you look at, the UK, the US, any other more mature mortgage market, the banks understand those profiles better. They understand how to account for that risk a little bit better. So those people do end up taking mortgages, and that's quite a big difference. And I think you're seeing that in the UAE. We're starting to see banks be a little bit more flexible with the products they offer and how they offer. So I think over time, you're going to see that 30% grow and grow out here, and you'll see it reach a balance. I think it eventually gets to 50-50. There still will always be a large amount of cash transactions here. But at least for our sake, we hope we hope the 30% goes up.
Totally. I think we could do a whole episode on just property and mortgage in the UAE. I think there's so much that I would still want to ask you, but I think there's other topics that I would like to cover as well.
There's definitely better people to ask than me as well. If you want to go into mortgage specifics, I'd get one of the Holo founders down here.
No, I mean, definitely their perspective would be interesting, but as I said, I think there is this whole realism attached to when you speak to a CFO, which has its own value. I'll move to some of the other experiences that you've had. So I'll go to Taraboot, which is one of the open banking platforms. First of all, so I'll break this discussion into two. So I'm from fintech, and of course there is a lot of excitement in our company around open banking. Of course, what it enables in terms of new products for the consumers through the fintechs. So there is a lot of buzz going around in the market around open banking. But the reality is that quite a lot of people still have misconceptions around what open banking essentially is. What are some of the use cases? So tell us about what you have as an understanding around open banking and what was Taraboot doing around that space.
Yeah, so I think people's concerns around open banking is the word open.
Yeah.
I think when we look at open banking, we use the wrong word. Open banking is not open. It's not you sharing your data with absolutely anyone who has it. The core part of open banking is consent management. It's you being in control of your own data. It's you being in control of your payments and allowing that to be shared with the parties that you want to be shared. All it's doing for the fintech side of it is making that data more accessible to them, and it's easier. So take a lending example. If someone's trying to get a loan, rather than them having to get a salary certificate and bank statements and everything else you have to provide for a loan, if good open banking is in place and you've consented to it as a consumer, they connect to your bank via an API, they get all of that information directly. We can make decisions a lot quicker. And from a consumer standpoint, it's a much better experience. I think for open banking to pick up out here, because I think we have seen it be slow across MENA. I think Saudi was probably the leading driver when SAMA regulations came out about open banking. And we've now seen CB start to put out their open banking regulations as well. I think consumers should be in favor of this stuff. It's you taking control of your banking data back. Historically, the bank has owned your data. Open banking puts that back in your hands. And then I think the other side of open banking that's less talked about is the payment side of it, because we have so many good payment options out there in the market at the moment, right? Whenever you try and do a new form of payment, your bar is always going to be Apple Pay. Are you easier than Apple Pay? So are you easier than a double click and a tap? Which nothing is currently. Open banking payments in an API environment are that level of easy. They are biometrically driven. It will be a similar experience to Apple Pay. But all it means for the merchants is rather than having to pay the 2.5% to Visa and MasterCard, they're paying a 0.3, 0.4% to the open banking provider, because an open banking payment, in very simple terms, is as if you made an IBAN transfer directly to the merchant's bank account. So in terms of merchants, it works out a lot cheaper, which is incredible because especially for high volume e-commerce players, they do spend a lot in card processing fees. So the hope is that that saving then gets passed back onto the consumer. I just think as we stand right now, open banking payments aren't that biometric integration. So it's very difficult to move consumers off Apple Pay until you get to that point. I think there's a lot of good work being done out here. Tarabut, particularly focused on the sort of information side of open banking. So making that lending easier, making those credit checks easier for customers. And that's definitely, I think, the space we're going to see more of it out here. I think lending is probably the first space that you see open banking. And then over time, it'll grow and grow. I think if you look at the UK, which has one of the more advanced open banking environments, we're starting to see a good volume of open banking payments in the UK, which is great to see because that's almost the last part of open banking that needs consumer adoption. And I think just if you look at the types of fintechs that are able to be built in the UK on open banking rails, is really exciting for this region because we're so early in it. And I think this is a region that historically has supported fintechs very heavily. Like Mina loves fintechs. It always will. It'll always be the most popular child in startup because the ability for fintechs to earn money is quite a bit higher than most other industries that you get in startup. So I think once you add open banking into that, it'll just be a much, much better consumer experience for everyone.
Indeed, and I think as you pointed towards Saudis, I attended the Seamless conference, which happened a few weeks ago, a month ago, in Riyadh. I'm not sure if you were there as well.
I'm at Leap next week.
Okay, wonderful. So I happened to come across some great open banking providers over there. Some of the use cases, as you said, for merchants, but also for the consumers, where I don't remember the name of the company, but they had a platform which had open banking sort of integrations with the relevant banks, where through consent management, as a user, you could have all your bank accounts being placed in one of your apps, and then you can figure out how to allocate balances between the accounts, which one is offering you the better rate, etc. So a lot of consumer-facing products as well, which can be enabled through the open banking, right?
Yeah, I think that those push notification stuff that you can get into from open banking is super interesting. The most common example we used to use at Tarabut was if you have the product you're talking about is aggregation, where you get it all in one place. You could start push notifications to people saying, well, for the past 3 months, you've had $10,000 just sitting in your account earning a 0.5% interest rate. Why don't you put it into this 3-month fixed deposit that's going to get you 2.5%? It's not much. It doesn't sound like much in the grand scheme of things, but what it will allow people to do is really optimize how they spend their money and how they save their money and how they earn on that money. I think that space will be super interesting once it gets bigger. I think you're going to see a lot of fintechs grow due to that. I think as well, if you look at someone like Sawa, for example, if they have open banking integrations with their customers and they can send those notifications to their customer to say, hey, by the way, you've been sending 3,000 dirhams a month to Sawa, but we noticed at the end of the month in your bank account, you have 2,000 dirhams spare. Why not send that 2,000 as well? Up your deposit to 5,000.
Yeah.
And if you're getting that sort of 8 to 9% return in Sawa, you should. 8% on 2,000 a month over the course of 20 years is a fair amount of money. So again, I think that's where it's good for consumers. And it can be unintrusive. It's not someone coming trying to sell you a fixed deposit or sell you investment management. It's just a push notification that comes to your phone. And that's really what excites me. When you get into those mature open banking environments, the possibilities are endless, really, for what you can do with
Yeah.
it. So, and that's why I'm glad that there's a lot of really good players in the space. I have a bias for Terabit for obvious reasons,
Yeah.
but there is a lot of people building really cool stuff in that space.
Fantastic. Fantastic. Um, Moving on from Taraboot into your one of your earlier startups, which is Ogram.
Yeah.
So post the COVID, we've seen that there's been an explosion in gig economy, and sort of people have been making themselves available for different kind of works. People have more inclination towards flexibility in work. So tell us about what you did at Ogram. What were some of the challenges, or did you also notice a boom post COVID in your activity in Ogram?
Yeah, there was a huge one, particularly in hospitality. So the way we always described Ogram was it was Uber for hospitality staff. So our core area of providing staffing was hospitality, be that retail, restaurants, or hotels. And what it was what you saw post COVID was hospitality workers were probably some of the hardest hit during COVID because obviously restaurants shut down, hotels shut down, and you didn't have the money in those businesses to keep these staff on board. So a huge amount of hospitality workers were laid off during COVID, and obviously an extremely tough time for them. But what you saw off the back of that was it created a little bit of a lack of trust in them in the hospitality industry where they no longer wanted to be tied to a single restaurant or a single hotel, and they wanted to make sure that they were de-risked from any situation like that in the future. So these were the people who were like, let me work 2 days a week in this restaurant, 3 days a week in another one, and then maybe even work 1 day a week in retail. And that's really what we serviced at Ogram was that market, which I think the staffing market in MENA is, you're talking like a $600 billion market. It's absolutely massive. But there wasn't anyone servicing the flexible space. You have people like TransGuard, Manpower Group, all the big staffing agencies that will give you, 100 waiters for a month. But there's none of them that would give you one waiter for 2 days or one waiter for 1 day because someone was sick. That's what we focused on at Ogram was that flexible space, not the long-term staffing arrangements, but flexibility for restaurants to manage their costs. Because especially as well in MENA, summer is quite dead for hospitality out here. No one's here. So restaurants want to lower their staffing costs during those periods as well. So having that flexible working is great for restaurants and it's good for the workers as well. They get better experience. They're across a few different places. They see a bit more. And it was always our proudest moment when someone left the platform. So we had a number of people who started on the platform with us working as waiters flexibly. And we'd get messages from them saying, oh, one of the restaurants just made me the restaurant manager or a bar manager,
Cool.
and they would leave the platform. And now for every other app in the world, if someone leaves the platform, it's terrible. At Ogram, we were super happy for that because that was kind of the idea. Can we help these people get better experience and grow in their career? Very tough space due to the nature of dealing with people is always going to be a tough space. And hospitality is so fast moving. But still a company that is very, very close to my heart. I still talk to the founder probably once every 2 weeks at worst. They've just started in Saudi as well and doing really, really well out there. They have a presence in Greece, they're doing exceedingly well in Greece. I think the summer there with everyone going to the islands and stuff, flexible working is absolute boom. So that's great. But building really cool stuff. And I think you'll start to see that kind of gig economy work spread out across other industries as well. Hospitality is probably the easiest one to do it in. But I do think trend-wise, you're going to see more people move to those kind of models, potentially even in the more like white-collar space as well. Because I think what you see with the younger generation now is they don't have that intrinsic need to be tied to one company like people from our generation did, right? There was, for us, it was go work at PwC and be a PwC guy. But I don't think you see that as much in the younger generation. So I think you might even start to see some white collar flexibility as well, which is exciting to see how that's going to sort of change professional landscapes.
It's interesting, absolutely, because UAE is an expat-based economy, right? And usually you are sponsored by an employer. How far do you think that ease of requirements around sponsorship, now you have the golden visas and you can self-sponsor, etc. I think that, of course, feeds into the success of platforms like Ogram, etc. Because now you're not necessarily tied to a sponsor. You can figure out where you want to work based on the fact that you're self-sponsored, right? Does that play a role in helping companies like Ogram?
It did. It did. So the Dubai government, I'm not sure if they have released it, but they were also talking about basically a low income self-sponsor. So at the moment, if you self-sponsor, you're looking at about 8,000 dirhams for the visa, which obviously for a lot of people who work in hospitality is not a feasible cost for them. So what they did look at was a 1,500 to 2,000 dirham visa. That all it would require of that person was that they were working a certain number of hours a week to maintain that visa. And I think that's would probably be an extremely good thing for the country. You need people to feel like this place is home. You need them to feel that their place in the country is not tied to employment.
Yeah.
That I think historically that's what MENA has been like, and that's maybe put people off to some extent. So I think this flexibility that we see now in freelance visas and golden visas and allowing people to make MENA home has been really great for the region. And I think you see that in the data as well, where historically people's length of stay in MENA was, 2 to 3 years. It was come out, earn some tax-free money, take it back home. But now more and more you're seeing people stay longer, build families out here. And as someone who grew up here and considers it home, it's great to see more people start to feel that way.
Amazing. So, James, it has been so insightful listening to you about all these experiences that you have had with Holo and then previously with Ogram as well as Taraboot. So, this is all very, very valuable. I'm going to now take you back to your startup finance office, and we're going to essentially touch around two themes. One is financial strategies, and the other is specifically focused on fundraising because I understand you have extensive experience around fundraising. So, first, financial strategies. As a startup, of course, you're cash strapped. I mean, you have to manage the ship very tightly. You have, again, doesn't necessarily mean that you become a spend police, but the idea is that how do you strike that right balance between scaling as well as making sure that you make the most efficient use of your money. So that's one thing. While talking about that, I would like to also request you to touch upon how does the lens of a startup CFO is different from a normal corporate traditional CFO. So those are the two things. Let's just start with that, and then we'll dive into fundraising.
Yeah, I mean the cash versus scaling one is probably the most difficult thing to do as a startup CFO because you don't want to become that person who's saying no in the business, and you don't want people to have to limit growth plans or limit growth ideas. And I think what you see with startups is they find success in those big bets, right? Maybe it's a massive marketing campaign and you're not sure if it's going to come off, or it's a geographic expansion that you're a little bit unsure about. But the reality is that is where those great companies are made, and that is where unicorns are made, is in those big bets paying off. And everyone knows the failure rates, right? 90% of startups fail. Even I think 70% post Series A fail. So even if you've raised funding, there is still a very high chance of failure, but it's because of taking those big bets and them not working out that you fail. So I think your job as a CFO is sort of, I'm not going to stop this, but I'm going to make sure that we're spending the right amount, that we're not going over. What is the limit here? And then on top of that, what's the backup plan? So if we go out and spend $200,000 on this massive marketing campaign, we don't get the revenue that we thought we were going to get from it. What's the backup plan? Where do we go from there? How do you almost bring back spend over the following months to sort of correct the ship a little bit? And that constant runway management is such a difficult task. So you almost maintain three different plans in your head. One is everything's going really well. One is everything's going okay. And one is everything's gone wrong. What do we do now? So I think anyone who steps into that startup CFO role, what I say to them is make your everything has gone wrong plan first. Know what it takes to survive the business. If everything goes wrong, what do we need to do? What changes do we need to make so that we can become a profitable business tomorrow, run for a little bit, and build back some momentum? You have to have that plan in your back pocket just in case. And the founders of the business are never going to want to talk about that plan. They're never going to want to hear about that plan. They're never going to want to see it, right? Because it's scary to think true. That, oh my God, like one day the business might go super wrong. But I think as a CFO, you have to maintain that plan and you have to know what do we do if it goes wrong? Because at the end of the day, there's people's jobs are at stake here. People's livelihoods are at stake. And the founders have put a lot into this business. So the conversation that I have with founders is, here's what the plan looks like if you were to turn this into a lifestyle business. If we're no longer a venture business, this is what your business looks like, where you can continue to run this for the rest of your life. It may not grow, but it's going to be money for you every month. because everyone should have that plan of, okay, if I need to, this is what I do. So that is, yeah, it's an everyday thought. It's an everyday act of work as well. And then I think that touches on a lot about what's different about a startup CFO and a corporate CFO. Cash management is a huge part across both, but generally at a corporate level, your cash management is more treasury management rather than day-to-day cash management. It's more, how do I make sure that I'm getting the right ROI on the cash that we're spending, or am I holding too much cash, which is a problem startups never have, or where am I allocating these resources? Whereas a startup CFO is more day-to-day, I would say, than a corporate one. Corporate can be a bit bigger. And I think the other side of it is good startup CFOs are rarely just finance. I think to be a good or great startup CFO, you need to understand all of the business. You need to be willing to like roll up your sleeves and help out in any part of the business.
So right.
I make an example that literally on Friday, I made an accounting entry for an asset register. So we bought a laptop for someone. The two guys who worked in my team were both super busy. So I was like, let me do it.
Yeah.
And just that mentality of get it done, I think is what separates good from great startup CFOs, where the good ones will be willing to do most stuff. The great ones will be the guys who are willing to go and sit on reception if that's what it requires. Whereas for a corporate CFO, you don't have the time for that. And you're in a well-oiled business where someone is looking for you to just make sure the finance runs really, really well. And obviously the strategy, no matter where you are as a CFO, you're always going to be involved in that. But I just think the biggest difference, startup CFO to corporate CFO, is proximity to the day-to-day is a lot higher when you're a startup CFO.
This is so true, James. And this discussion excites me because,
I love it.
yeah,
Honestly, even I was so excited when I made an accounting entry on Friday. I know that sounds so stupid, but it'd been so long since I'd actually made an entry into an accounting system that it was kind of like a little moment of, oh, I do still know how to do this.
sounds like guilty pleasure, right? So you
Yeah.
don't want to do it, but you like doing it. I said it, I'm so excited to go a little bit deeper into this discussion is because it's very relatable for me. So this is my first startup experience that I'm working with now. It's been an exciting ride of the last 2 years. But before that, I've seen the corporate world as well, where I wasn't the corporate CFO, but I was working alongside corporate CFOs. So you're right. So these corporates are like big giant elephants who are moving at their pace. They thrive on their processes. They work like a well-oiled machine, just like you said. So they have their own, of course, pros, as to where their strength is, which is, solid processes, established protocols, and sort of nothing sways away from that,
Yeah.
generally speaking. In a startup world, what I've seen the last 2 years that I've been working as the head of finance, I mean, I lead the financial strategy. There's no CFO of our company yet. But the idea is that what I've seen, James, is that as a startup CFO, you have to run towards the sound of gunfire.
Yeah.
So basically, it's not like you run away from it. You have to run towards, just like you said, it's a small example, but many other things where you think something is breaking, you rather than running away, you run towards it to figure out what has happened, because the speed of information is the key over here. Because the more late you are, the more you could bleed in that time period. So that's what I've seen. The other thing what I've seen, and I would definitely like to hear your thoughts as well, because you have extensive startup experiences around the bias towards tooling and automation. I have seen disproportionate bias. I've never been involved with so many tools that I've been involved now in the startup, is because as a startup CFO, you want to move away from washing the dishes to planning the menu. So, I mean, washing the dishes mean you need to move away from closing the books and plan ahead as to what's coming forth, right? So, where what we have seen in our startup, James, is that you're open to deploy and implement as many tools. Of course, they need to make business sense as you can. So there is a bias towards tooling and a less bias towards hiring, which then automates and makes the processes more efficient.
Yeah, I think it comes from being venture backed a lot of times. So
True.
if you think about what venture capital companies look for in their investments, it is that almost unlimited scale, right? If you're a business that presents now and you have, let's say, a 40% gross margin, a venture company is going to look at that and say, well, how does it become 50? How does it become 60? How does it become 70? In a corporate, you kind of accept your margin for what it is. You might make little tweaks here and there, but if you're a 20% margin company, you're a 20% margin company, and then you just manage OPEX to make sure that the profit looks right. In a startup, 9 times out of 10, we're not profitable. So and all of the OPEX you have there is required. So you can't manage the OPEX down. So how do we become profitable? We have to manage gross margin up. And how do you generally manage gross margin up? It's through automation and better process, or building out better tools for your team. I do think there can be an over-indexing on tools at times in startups. I think because a lot of times the startups are working in tech or with tech, we think we have to use everything tech that's available.
Yes.
And I think it's a particular problem in the finance space at times. There is certain finance stuff that you are never going to automate. We just have to accept it. You're never going to get a fully automated bank reconciliation as much as we'd like to. It's still going to have a person who has to check it at the end of the day. So whilst I think it's super important to keep up to date, and don't get me wrong, there is a ton of tools out there in the market at the moment that I love. Like top of my head, you look at the spend management platforms, so your Cashios, your Alans, great work. You look at your reporting tools like Kudwa, great in the space. You look at accounts receivable stuff like Okta, again, really great tool that saves time. And it's about finding those tools that save on admin, which is the three that I mentioned there. That's admin saving. If it takes me less time to put together a consolidation to do my reporting, brilliant. If one of my guys in my team is not spending his time chasing invoices, brilliant, good saving. And if my team is not having to spend time chasing receipts, again, brilliant. We don't have to automate everywhere.
Yeah.
Automate where the admin is. I think the space I'm very against automation is in reporting. I see a lot of people building out like AI tools to do your month-end commentary for you and stuff like that. And for me, if I'm not in the month-end commentary, that's where I'm learning about the business, and that's where I'm coming up with a lot of our ideas and things like that. So if I automate that, what am I doing? Like, how close am I
Yeah.
to the business? So I do think there is a fine line between optimizing and over optimizing. And I do think at times startups can lean over a little bit. So I just say to anyone out there who is looking at bringing more tools into a finance function, make sure you're doing that work to say that it's not taking you away from
Yeah.
something important, that it's automating admin, it's automating monotony, but it's not taking away from a task that actually brings value. Because to use a very stupid example, even the bank reconciliation can be so valuable. It's another point in time for you in the month to check your cash again, to
True.
see where we're spending again. So don't take yourself out of everything, because as a startup CFO, you need to know everything that's happening in finance. And if you over automate, you're going to lose that touch.
I'll just close this absolutely to the right point. And he said that sometimes you over index on automation. There's something very interesting that one of my colleagues say. He says that you need to do something enough number of times manually to exactly know how it needs to be
Yeah.
automated. Sometimes you're like, oh, automate it today before even realizing how it looks in a manual form. So that's something very useful that I've learned from him. I'll take this discussion quickly into the fourth gear towards fundraising. Because something important that you mentioned around trends. So again, for example, gross profit trend, for example, right? What I've heard others, more polished CFOs, and for example, hearing from them is that as a CFO, you're not hired to maintain trends. You're basically always should be thinking about breaking the trends, right? I mean, if it's just about maintaining the trend, then what's the point of having a more
Yeah.
expensive CFO, right? You need to think about if it's 10%, how does it become 11 to 12, and then forward from there. And this story is particularly plays a role and crystallizes at the time of fundraising. So James, just run me through. I mean, you have extensive experience around fundraising and of course forecasting. What's the right balance between wowing or exciting your investors to also not losing your credibility, because you need to make sure whatever you present, you have to follow through on that one. And connecting with this, what are some of the misconceptions around fundraising? Because I see very often big headlines, people celebrating around how much they've raised, and 1 year down the line, the company has failed. So just share your thoughts around these two threads.
First and foremost, don't celebrate fundraising. Fundraising is a necessity of a business, of a venture-backed business.
Yeah.
It is not something to be celebrated. Celebrate the wins that the business has. Celebrate winning a new customer. Celebrate growing market share. Don't celebrate fundraising. Fundraising is just something we have to do. And we're lucky to exist in a region where there is a lot of venture capital available. So I think that's the first thing. Stop having your biggest LinkedIn announcement of the year being
Right.
fundraise. Have it be a massive partnership that you signed or a new market entry or something. In terms of what you spoke about with the balance between credibility and wowing, I look at it a bit differently. I think those forecasts that you send to VCs are always going to be at the higher end of possibility. But the reality is, if that's not our ambition, why are we in venture, right? If we don't think we can 3x revenue every single year, why are we in venture? Because that's what we're trying to do. we're trying to break into incumbent markets. We're trying to do something a little bit differently, which should give us sort of abnormal returns in what we do. So I think it is important to present that ambition when you're speaking to investors. Always maintain truth. Like this is not me going out and saying lie or, tell the investor I'm going to 100x my revenue next year. No, have it based in a world that can happen, but have it be the very higher end of that world.
Okay.
Because that's what they want to see. Because especially at the earlier stages of fundraising. So all of my experience is seed and Series A raises, where you're still a very young company. This is not talking about like Series C and Series D raises where you're getting into that pre-IPO time and things get a bit more nitpicky over what they're looking at. At a Series A or a seed, a venture capital fund wants to back an ambitious founder and they want to back an ambitious company. So you have to show them what that ambition looks like and what does that blue skies look like for the business as well. So that's really, really important. And the reality is in a fundraising process, that all that model or that pitch deck is going to do is get someone into DD. And then they're looking at your real numbers. They're looking at the actual business. And that is where deals are won and lost. You're not winning a deal because of your pitch deck and you're not winning a deal because of your forecasting model. You're winning a deal because of how the DD process went.
Correct.
So that's got a lot longer nowadays. I mean, you're talking 3 to 4 month DDs, potentially longer. I'll say if you're doing it for the first time, if you're listening to this and you're about to go into your first fundraising process, be ready to not sleep a lot. Be ready to answer the same question over and over again. Be ready to answer a lot of questions. Be ready to have a lot of calls.
Yeah.
And the most important thing throughout that is not always the type of answer you give, but it's that consistency of answer. VCs speak to each other. They all speak to each other.
Yeah.
And if you give an answer to one VC that's wildly different to an answer you gave to another one, that can kill a deal. Just because that inconsistency can be so problematic, especially if it presents two very different visions or directions for the company. So my advice to people in that regard is every time you get asked a question in a DD, write down the question, write down what your answer was. If someone asks you that question again in the future, great, you don't have to do the work and rewrite an answer. You have it ready to go. And keep that track for yourself in terms of what questions were we asked, how did we answer them. But yeah, be prepared for a long, sleepless process. I think at this point, I think I've been fundraising for almost 3.5 years straight across 3 companies. It's been a while since I had a good night's sleep. But yeah, it's fun.
Yeah.
Fun is the wrong word. It's a good experience, I think, for people. And I think it's unlike anything else. So I've worked in PE-backed companies prior to venture, and that's a very different experience. But venture, it can be extremely fun. And I think for the founders, that moment of someone investing in the business is a moment of belief in them as a founder more than anything else. It's that someone believes in me enough to give me $5 million. That's a huge statement of credibility. So I do understand the penchant for wanting to celebrate it, but there's better things to celebrate. Like celebrate the fundraise internally, but a year down the line, you should be celebrating what you did with that money, not celebrating another fundraise.
Totally. No red carpets for raising funds. Absolutely.
No.
No, totally. I think one very important thing that you said is about speaking truth, and just this rang something in my mind which says that the good thing about speaking the truth is that you don't have to remember what you said.
Yeah.
So that's very good. Cool. In the last 10 minutes, James, I would like to touch on 2 topics. One, of course, is the stakeholder management, especially to do with the CEO, and then we're going to have a quick rapid fire to close it off. So I think from a CEO CFO relationship perspective, what I've learned, what I've heard is that the relationship between the two is between like a hand and a glove relationship. How do you approach this as a CFO?
It's a marriage. And I mean that in all the good and bad parts of a marriage. I think that in that time, it's how close you have to be to the CEO. Both of you need to be in lockstep in decisions. You need to have that agreement with each other on where are we heading as a business. And predominantly that vision should come from the CEO or founder in a startup. And you as a CFO is one, a little bit pulling them back to reality. If the plans are a little bit too big or something we can't do, you need to almost be that voice of reason at times, but not to the point that you're stifling them. And then I say it also incorporates the bad parts of a marriage, right? When you When you are married to someone, you have that ability to have very tough conversations with them, and you have the ability to have an argument where you're extremely angry at each other, but then 10 minutes later it can be fine. That short-term memory between a CFO and CEO is really important, because you need to be able to get in a room with each other, scream at each other, whatever it takes for 15, 20 minutes. But when you walk out of that room, it has to be as if nothing happened. I think I've had enough tough conversations with CEO. I'm not saying we screamed at each other, but those tough conversations where we challenge each other, push each other to be better, but then to the business, we are in lockstep. Whether we agree or disagree on a decision, outwardly to the business, you're in lockstep together. And then you have those other conversations a bit more privately. I think it's just so important to maintain that relationship and to have that openness. I think if you're working as a CFO and you don't have that openness with the CEO or whoever the founder is, and you can't have those really, really honest conversations with them, you're going to struggle a lot. You need to be able to have those honest conversations and not have hard feelings come out of it. So definitely when you join a business, day one, start building that relationship. Maybe even prior to you joining, you start building that relationship. If you're an early stage startup CFO, you should be speaking to the CEO every single day. There shouldn't be a single day where you don't have a conversation. And just build that over time. Find the cadence that works for you. Find the communication that works for you and the CEO. Find how you both want to manage that relationship, because you both need to be comfortable in it. But it's definitely one of the most important relationships that exists in a business. And I think especially at the startup level where strategy is so tied to cash, and it is so tied to what we have the ability to do. So make sure you're just constantly nurturing that relationship. And if you get to a point where you need to scream at each other, just do it. Just get in a room, scream, and be done with it. Like the sort of bitey, backstabby, taking
100%.
passive aggressive shots at each other just won't work.
Yeah.
Just get in a room, shout it out, and then shake hands and be done with it.
No, that is super, super useful. I think the idea is with what you just said, I think what it does is that it doesn't keep the organization hollow, right? So you have, as you said, I mean, you can have disagreements, respectfully tell each other what's wrong, don't keep it in the heart, especially to the outside world. You're one team, one vision, one roadmap. And I think that's where you're seen positively by the investors and the ventures, if you have ventures on your board. Cool. All right. So in the last few minutes, I think we would move rapidly through the rapid fire round. Quite excited for this. This is the first time I'm doing it, but let's see. So I'm gonna throw a bunch of questions towards you, and I expect an answer which is as short as 1 to 2 to maximum 3 words. Right? I mean, I'm not stifling you. You could choose to answer it longer, but the idea is to go around with a few words. All right. So what's the biggest myth about being a CFO?
That it's just finance.
Okay. EBITDA versus adjusted EBITDA.
Both bullshit. They are.
You sound like Warren Buffett and Charlie Munger right now, but you're right. You're right.
Both useless metrics. Use net profit.
Okay. Oh man, this is so good. I'm sure some of the valuation guys are not going to like it, but this is very good.
No.
All right, your take on IFRSs.
Important.
Okay. Your favorite financial buzzword these days.
Leverage.
What does these mean in your life? Trial balance.
Boring. I associate it with audit, so it's the only time I ever look at a TV.
All right. KPIs dashboard.
Tracking.
Google.
Search.
ChatGPT.
Useful.
Okay. What's your favorite finance-related TV show or movie or a book?
I'd probably go book, Secrets of Sand Hill Road.
Interesting. If your career were a movie, what would the title be?
Failing Upwards.
Oh, nice. That is so solid. Worst financial advice that you've ever received?
Personal or professional?
Whatever you choose to.
Invest in penny stocks.
One skill every CFO must have but rarely does.
Empathy.
Okay, that's good. Soft, but good. If you were offered one superpower as a CFO today, what would that be and why?
Not needing to sleep, just so I had a bit more time in the day.
Oh, that's good. I like that. Relatable as well.
Yeah, especially at the moment.
If you could swap lives with any CEO or CFO, whether past or present, who would that be and why?
Wow. Maybe just one of the sort of like big tech companies, like Google, Meta, someone like that. I just think running a business of that size that's still growing at that rate and has such influence on the world, I think it would just be such an interesting space. It wouldn't
Yeah.
even be about the finance side of it. I kind of want to see how those companies run. So being a CFO, you get to see a lot of it.
Yeah.
I think that'd be probably insanely stressful. I'd have a lot more gray hair, but I think it'd be fun.
Amazing, James. James, this has been thoroughly enjoyable, super intuitive, and very, very valuable to me personally, and I'm sure to the audience as well. In your closing thoughts, I would just like to share a piece of advice with three audience personas as I started this discussion with young finance professionals who are just starting out on their finance career, mid-level finance professionals who are approaching the CFO or more senior level roles, and fellow CEOs or CFOs. Your closing thoughts to these three personas.
Yeah, for entry level, the easiest advice I can give is put in the hours. So the first 5 years of your career, if you want to have an accelerated career, it sometimes really is as simple as put in the hours. So I talk about PwC with this. You'll do 70, 80-hour weeks, and it's not easy, but it will serve you really well in the long term. So put in the hours. Just put in the hours. It's that easy. Mid-level, I would say expand outside of finance. That's the right time to start learning about the other parts of the business, learn how people functions work, learn how marketing functions work, because at that mid-level, you're prepping yourself for that next step. And at the next step, that is going to be the expectation of you that you understand the functions at least to a decent level. For fellow CFOs, breathe, breathe. I have to remind myself of that at times, that sometimes you'll be faced with situations that seem so dire, and it seems like there's no way out, but at times it just takes a couple of deep breaths, potentially walking away from your desk, the situation, whatever it may be. Just breathe. You're in these positions for a reason. Someone hired you for a reason. So just take the time. Not everything has to be a decision at a million miles an hour. You do have that breathing space. So yeah, breathe and sleep.
Wonderful. Very useful. James, again, thank you very much for being on the show.
Thanks for having me.
Thank you so much. All right, guys, I hope you enjoyed today's episode. To me, it was super valuable. James is a CFO who has an extensive experience across a very different nature of business, which is startup life. If you would like to connect more, or if you would like to know more, you can connect with James on LinkedIn. He's quite active over there. Till next time, see you there. Bye-bye. Have a good one.